Good morning, ma'am. Good morning, classmates. Our topic today is all about analyzing financial statements and creating projections. Learning outcomes. Number one, prepare financial statements such as balance sheet, income statement, cash flow, projections, and summary of sales and receipts. Number two, interpret financial statements. And number three, identify where there is a profit or loss for a business. Financial plan. It refers to the capital investment and sources of funding the operations of the business. So kung magkuan kag isa ka business, kinahanglan sa nimo maghuna-huna kung pila ang imong i-invest na kapital sa imong business. Number 2, the process of determining whether an entrepreneur's idea is viable foundation for creating a successful business. So kinahanglan pod is ganing maghuna-huna kag mga idea o kanang setable sa imong business o kanang mas para mas kung sa tong mga product na mas ma-attractive pud sa imong business sa mga customer ug para ma-success ang imong business. Next, it also helps in comparing the costs and benefits over time to determine whether a project is profitable or not. Next, preparation of the projected financial statements. Number 1, according to Dr. Baltazar, 2015, the proponent should prepare following projected financial statements for a period of 3 or 5 years, which is composed of the following. The projected income statement shows the revenues, cost of goods sold, cost of sale, operating expense, categorized into two types: marketing or distribution expenses and administrative or office expenses, other income and expenses, financing costs, income tax, and the bottom line figure, the net profit after tax or net loss. Next, assets represents the resources controlled by the entity, results, past events, and from which future economic benefits are expected to flow to the enterprise. The asset has two categories: the current assets and the non-current assets. Next, the projected statements of cash flows, which reflects the sources and uses, cash and cash equivalents. There are three sources and uses of cash, such as operating activities, proceeds from the sale or cash services, revenues, payment for expenses, payment of inventories for cash, and the payment of accounts payable. Investing activities, proceeds from sale, purchase for cash of the property, plant, and equipment and investments. And lastly, financing activities, cash proceeds from the investment of the owners or issuance share of stocks, proceeds from borrowings, and cash payments for withdrawal of owners and payments cash dividends. Examples of current assets that are reported in the statement of financial position according to liquidity, the ability of asset to be easily converted into cash and to pay its short-term obligations on time are: number 1, cash and cash equivalents; number 2, marketable securities or short-term investments; number 3, accounts receivable, net of allowance for bad debts; 4, short-term notes receivable; 5, other non-trade receivables such as advance to employee; number 6, inventories; number 7, prepared expenses. Examples of non-cash assets are: number 1, property, land and equipment; 1.1, land; 1.2, building, net of accumulated depreciation; 1.3, land improvements, net of accumulated depreciation; 1.4, office equipment, net of accumulated depreciation; 1.5, office furniture and pictures, net of accumulated depreciation; 1.6, store equipment, net of accumulated depreciation; 1.7, store furniture and pictures, net of accumulated depreciation; 1.8, transportation vehicle, net of accumulated depreciation. Number 2, long-term investments. 2.1, investment in associates; 2.2, investment in bonds. Number 3, intangible assets. 3.1, goodwill. 3.2, patent, net of amortization. 3.3, trademark, net of amortization. 3.4, copyright, net of amortization. 3.5, leasehold rights, net of amortization. 3.6, computer software, net of amortization. Liabilities are present obligation of enterprise arising from past events, the settlement which is expected to result in an outflow from entity of economic resources embodying economic benefits. Liabilities have two categories, the non-current and non-current liabilities. Current liabilities are economic obligations that are payable within 1 year or normal operating cycle. Whichever is shorter. Examples are shown below. Number 1, trade accounts and notes payable. Number 2, accrued expense payable such as accrued salaries payable, expense already incurred but not yet paid. Number 3, unearned income or revenue, income already received in advance but not yet earned. Number 4, income tax payable. Number 5, withholding tax payable. Number 6 is premium payable. Number 7, pag-ibig premiums payable. Number 8, health premium payable. Non-current liabilities are economic obligation that is payable within 1 year. Examples are number 1, long-term bank loan payable. Number 2, bonds payable. The capital represents the residual interest in the assets of the enterprise after deducting all of its total liabilities. For single proprietorship and partnership, the capital is computed as follows. Initial investments of beginning capital, add additional investment, net income, total less withdrawal or drawing ending capital. So, mao ni siya ang the resulting net loss has a negative impact and was deducted from capital balance. So, for corporation type of business, the capital is computed as follows. Mao ni siya ang kuan kibali ang iyang pag-plus star kung unsaon pag-compute sa capital. Na include rin ang issued shares at fair value, additional paid in capital, share premium in excess of fair value, etc. As you can see in this figure, mano siya ang format sa projected balance sheet or statement of financial position. Naka-include na rin name of company, projected balance sheet or statement of financial position, year 1, year 2, year 3, year 4, year 5, na assets, current assets, cash and cash equivalents, schedule 7, marketable securities or short term investments, trade and other receivables, schedule number 8, inventory, schedule number 9, prepaid expense, schedule number 10, total current assets at non-current assets, etc. Below is the computation of the cost of goods sold or cost of sales for trading or merchandising business. It includes beginning merchandise inventory at cost, add net cost of purchase, gross purchase, add freight and total, then less purchase discounts, purchase returns and allowances, total goods available for sale, plus ending merchandise inventory at cost, cost of goods sold, or cost of sales divided by the total units sold, estimated unit cost of goods sold. Next, for the manufacturing setup, the computation of cost of goods sold or cost of sales is shown below. Mano siya ang computation sa cost of goods sold or cost of sales. Include na din ang beginning raw materials inventory, add net of cost purchases, add net cost of purchases, gross purchases, add freight in, then total, less purchase discounts, purchase returns and allowances, total raw materials available for use, etc. Next, for the preparation of the projected income statement, the following are the details of the expense to be reported. Number 1, operating expenses. 1.1, marketing distribution expenses will include 1.1 advertising and promotion expense, 1.1.2 rent expense store, 1.1.3 salary expense store, 1.1.4 fit out transportation out, 1.1.5 delivery expenses, 1.1.6 store supplies expense, 1.1.7 depreciation expense store equipment, 1.1.8 depreciation expense store furniture and pictures, 1.1.9 utilities expense store, 1.2 administrative or office expense, 1.2.1 office rent expense, 1.2.2 insurance expense, 1.2.3 office salary expense, 1.2.4 office supplies expense, 1.2.5 bad debt expense, 1.2.6 office utilities expense. Next, 1.2.7 depreciation expense office equipment, 1.2.8 Depreciation expense office furniture and fixtures. 1.2.9 Depreciation expense office building. Number 2 Other income. 2.1 Gain on sale of old equipment. 2.2 Gain on sale of investment. Number 3 Other expenses. 3.1 Loss on sale of old equipment. 3.2 Loss on sale of investment. 3.3 Purchase discount loss. Number 4 Financing cost. 4.1 Interest expense on bank loans. Number 5 Income taxes. 5.1 Income tax on net profit before tax. Next, the example of the projected income statement is shown below. Name of company, projected income statement, year 1, year 2, year 3, year 4, year 5, gross sales revenue, schedule 1, less sales discounts, sales return, and allowances, etc. So, mga siyang examples sa projected income statement. Next, the three significant parts of the statement of cash flow are the following. Number 1, operating activities. 1.1 source of cash. 1.1.1 cash sales or cash service revenues. 1.1.2 collection from trade accounts and note receivable. Number 2, financing activities. 2.1 source of cash. 2.1.1 cash investments by the owner. 2.1.2 proceeds from the issuance of shares. 2.1.3 proceeds from bank loans. 2.2 uses of cash. 2.2.1 cash withdrawal by the owner. 2.2.2 payment of cash dividends. 2.1.3 purchase of treasury shares for cash. For discussing purposes, treasury shares are those previously issued but required by the corporation for some important reason, such as improving earnings per share and shares to be allocated for the employees of the company's stock purchase plan. Number 3, investing activities. 3.1 sources of cash. 3.1.1 proceeds from the sale of property, plant and equipment. 3.1.2 proceeds from the sale of investment. 3.2 uses of cash. 3.2.1 cash payment for purchase of property, plant and equipment. 3.2.2 cash payment for the purchase of investments. As you can see in this figure, below is the format of the projected statement of cash flows. Ano siyang format sa projected statement of cash flows. Next, financial analysis. Based from the book of Dr. Baltazar, he mentioned that after the projected financial statements are prepared, the proponent should perform the financial analysis, such as computation of ratios, break-even analysis, capital recovery analysis, net present value computation, and sensitivity analysis. For analysis of the projected financial statements, ratios that may be computed are the following. Number 1, liquidity ratios. Number 2, profitability ratios. Number 3, solvency ratios. Number 4, activity ratios. So number 1 is liquidity ratio measures the ability of the enterprise to pay its short-term obligation. Ratios under this category are: number 1, current ratio, total current assets, then total current liabilities. It indicates short-term debt paying ability. Number 2, acid test ratio, total quick assets. It includes inventories and prepared expense. Then total current liabilities, immediate short-term liquidity. Number 3, net working capital equals total current assets minus total current liabilities, amount to meet current debts and carry sufficient inventories. Next, profitability ratio measures the health of the financial condition and effective management and the ability of the enterprise to earn satisfactory profit and return on investment. Ratios under this category are: number 1, gross profit equals gross profit divided net sales, then margin between selling price and cost of sales. Number 2, profit margin. Profit equals profit divided net sales, net income generated by each peso sales. Number 3, return on total assets equals profit divided average total assets. Then it measures the profitability of assets. Number 4, return on equity equals profit divided average equity. Then profitability of the owner or shareholders investment. Number 5, assets turnover equals net sales divided average total assets. It measures how efficiently assets are used to generate sales. Next, solvency ratio measures the ability of the enterprise to pay its long-term obligation as they are due. Ratios include: number 1, debt to total assets equal total liabilities divided average total assets. Then percentage of total assets provided by creditors. Number 2, debt to equity equals total liabilities divided average total equity. It is level of borrowing relative to funds used to finance the enterprise. Number 3, times interest earned equals earnings before interest expense and tax divided interest expense. It is ability to meet interest payments as they become due. Next, activity ratio also measures the liquidity ratio of the enterprise, such as number 1, accounts receivable turnover equals net credit sales divided average accounts receivable. It is liquidity of receivables. Number 2, average collection period equals 365 days divided accounts receivable turnover. It's liquidity of receivables and collection success. Number 3, inventory turnover equals cost of goods sold divide average liquidity. It is liquidity of inventory. Number 4, average days in inventory equals 365 days divide inventory turnover. It's liquidity of inventory and inventory management. Next, break-even analysis. Part of the financial aspects is the determination of a number of it to be sold at break-even point, or the amount of projected break-even sales where the enterprise will not earn a profit nor incur a net loss. It is important for the proponent to have the knowledge of the break-even point when he or she decide whether to introduce new product lines, etc. Formulas to compute for the following. Number 1, break-even sales in units equals total fixed cost divide contribution margin per unit. Formula to compute contribution margin per unit: unit selling price, unit variable cost, unit contribution margin. Number 2, break-even sales in peso equals total fixed cost divide contribution margin percentage. Formula to compute contribution margin percentage: contribution margin percentage equals unit contribution margin divide unit selling price. Number 3, required sales in units to earn the target profit equals total fixed cost plus target profit divide contribution margin per unit. Number 4, required peso sales to earn the target profit equals total fixed cost plus target profit divide contribution margin percentage. Next, illustrative example. Joey Maya Company, a manufacturer of wooden cabinet, had the following data for 2015. Sales in units 1,500, sales price 1,500 per unit, variable cost 750 per unit, fixed cost 195,000. Required, compute the following. Number 1, contribution margin per unit. Number 2, contribution margin percentage. Number 3, break-even sales in units. Number 4, break-even sales in peso. Number 5, required sales in units to earn target profit of 175,000. Number 6, required sales in pesos to earn target profit of 175,000. Next, computations. Number 1, contribution margin per unit. Sales price per unit is 1,500, variable cost per unit 750, contribution margin per unit 750. Number 2, contribution margin percentage. Contribution margin percentage equal unit contribution margin divide unit selling price equals 750 divide 1,500 equals 50%. Number 3, break-even sales in units. Even sales in units equals total fixed cost divide contribution margin per unit equals total fixed cost is 195,000 divide 750 equals 260 units. Next, proof. Sales 260 units times 1,500, then mana na siyang 390,000. Next, variable cost 260 units times 750, mana siyang 195,000. Next, contribution margin 195,000, then less fixed cost 195,000, net income is 0. Number 4, break-even sales in peso. Break-even sales in peso equals total fixed cost divide contribution margin percentage equals ang sa total fixed cost in 195,000, then divide 50% equals 390,000. Number 5, required sales in units to earn target profit of 175,000 equals total fixed cost plus target profit divide contribution margin per unit. Ang total fixed cost ay 195,000, then sa plus siya sa target profit 175,000 divide 750 equals 370,000 divided 750 equals 493.33 units. Next, proof. Sales for 93.33 units times 1,500 mano siyang 740,000. Variable cost for 93.33 times 750 mano siyang 370,000. Contribution margin 370,000. Less fixed cost is 195,000. Net income is 175,000. Number 6. Required sales in pesos to earn target profit of 175,000 equals total fixed cost plus target profit divide contribution margin percentage. Ang sa total fixed cost is 195,000 i-plus siya sa target profit man siyang 175,000 i-divide siya sa 50% equals 370,000 divide 50% equals 740,000. Next, capital recovery. It is important for the proponent to estimate the number of years to recover the investment of the project. The shorter the number of years of recovery, the better it is for the enterprise. The payback period method is a quick evaluation of capital investment projects. The formula is sa payback period man siyang net equals net initial investment or capital divides sa annual net cash inflow. It is assumed that the annual net cash inflow is even throughout the period. Next, for example, the initial investment was 1,200,000 and the annual net cash inflow is 480,000. Then the payback period is 2.5 years. If the annual cash inflows are uneven, the payback period is found by recovering the cost of the investment or capital year by year. For example, year kay 0 sa cash flows is 950,000, then sa unrecovered investment 950,000. Year 1 is 400,000, then sa unrecovered investment 550,000. Sa year 2 is 400,000, then ang unrecovered investment 150,000. Sa year 3 is 200,000, then sa unrecovered investment niya is 0. In year 3, the cost is totally recovered using only 150,000 of year 3, 200,000 ano siya 75%. The payback period is 2.75 years. Essentially, the payback period can be used to estimate the project's internal rate of return, IRR, project assuming a fairly high rate of return, siya ang sa high rate of return, ROR, over 20% and the project life that is more than twice the payback period. For example, if a 400,000 investment earns 100,000 per year and could last for 12 years, the payback period is 4 years. The reciprocal of the payback period 1 is divided by 4 and gives IRR estimates of 25%. Net present value approach. The proponent must determine the interest rate to be used in discounting the net cash flows, which in return referred to as the discount rate of or required rate of return. Under the NBP ruling, the proposed project is acceptable if the net present value is equal to 0 or positive. However, the project is rejected if the NBP is negative. For example, the proponent capital investment amount to 1,300,000 and it is assumed that the project net annual cash flow is 240,000 and uniform or even later out the period. It is assumed that the present value factor is computed using the discount rate of 12%. The present value of an annuity of 1 for 10 payments is 5.650 to 2. Present value of the net cash flows is 1,356,050 masyang 240,000 times 5.65022. Then capital investment or outlay man siyang 1,300,000. Then ang net present value niya is 56,000. Decision, since then the NPV is positive, the proposed project is acceptable. In the event that the net cash flow is uneven or not uniform, the present value of a single future amount for each annual cash flow is used. The example is shown below. Year 1, assume net cash flows is 340,000, discount factors close parenthesis 12%. Ang iyang discount factors is 0.9286. Ang present value niya is 303,570. Year 2 to 300,000, ang discount factor niya is 0.79719. Ang iyang present value is 239,160. Year 3 is 270,000. Ang discount factor niya is 0.71178. Ang iyang present value is 192,180. Year 4 is 250,000. Ang discount factor niya is 0.63552. Ang iyang present value is 158,880. Ang total sa asyang net cash flows is 2,400,000. Ang total sa present value is 1,443,670. So, ang present value of net cash flows is 1,443,670. Ang capital outlay or investment is 1,300,000. Ang net present value niya is 143,670. Decision: since the NPV is positive, the proposed project is acceptable. Next, the sensitivity analysis. The proponent should perform the sensitivity analysis on the basic state of financial projections to identify the effect of adverse change in critical variables such as volume and sales price of the product, the interest rate on borrowings related to capital assets, capital costs, and even the operating expenses on the financial viability of the proposed business project. Next, financial statements. According to Fajardo from his book titled Entrepreneurship, he mentioned the need for financial management because next to people, money is the most important resource of any business organization. Good financial management can ensure the following. Number 1, financing priorities are established in accordance with organizational objectives. Number 2, spending is planned and controlled in the line with established priorities. Number 3, funds are obtained and used efficiently. Next, developing the financial plan. Number 1, establishing objectives. Number 2, budgeting. Number 3, identifying source of funds. Next, evaluating financial performance. Based from the book of Fajardo on entrepreneurship, plans are simply written statements. These are useless if they are not implemented.
The use of ratios in financial analysis. Number 1 is measure of profitability, which may be further subdivided into sales and profits comparison ratios and profits compared with assets ratios. So in sales and profits comparison ratios, the first of these ratios is your net income after taxes to net sales. This ratio presents your company's total earnings after taxes as they compare with total revenues, an indication on whether an acceptable percentage of your after-tax income has been realized from your net sales production. It may be desirable for you to analyze some of your expenses as they relate to your sales. For example, it may interest you to know the relationship of your total raw material cost or your direct labor cost to net sales. Going a bit further, you could do this same procedure to all your other expenses, in which case, your analysis will then permit you to work carefully and determine up to what extent you could increase your operational expenses and still sell without a loss. And letter B, profits compared with assets ratios. Financial rate of returns fall under this grouping. They evaluate a company's earning power. The most common are the return on overall assets, which measures your company's adequacy of net income. It measures how productive your assets have been during your last operating period. This ratio is given by the formula net income over the total assets. In line with this formula, your rate of net operating income to total assets, your rate of income before after taxes to total assets, etc., may be computed for comparative presentations. The return on assets help you to analyze your total income as they compare with each of your different types of assets: current assets, fixed assets, intangible assets, and other assets. They help you examine how these different types of assets compared with your total earnings. More detailed computations on these rates of returns include each specific assets as percentage of total income. So, your company's returns on investments may be computed by using this formula, net income over total owner's equity. In using rate, your total owner's equity may vary within the accounting period. It is then that the average owner's equity is used. A situation may arise when you have a high return on investment and still have unsatisfactory investment. This happens when you use an outdated asset base. It is therefore advised that when using this formula, always use a current values for your figures. For corporations, a useful method for determining rates for returns on owner's investment in the return on common stocks equity, which is given by formula net income less dividend requirements on preferred stocks over average common stocks equity. This rate depends on the company's financial structure and policies. It must be noted here that the average common stockholders' equity in the formula is your company's residual equity. The total equity remaining after provisions have been made for the claims of all other equity holders. Method that relates stockholders' cash investments with future dividends or returns is the payback period, which is computed in several ways. Payback period refers to the time needed for stockholders to fully recover their initial investments, which made these formulas more important to the investors. Some of these methods are net investment to annual cash flows, bailout payback method, present value payback method. Other methods in this group are profitability or desirability index method, book values per share of stock, price earnings rate or earning per share, market value to earnings per share, payout rate, dividend per share to earnings per share. The inverse of your payback, known as the payback reciprocal, is another way of determining your project's investment repayment in the form of total income earned over a period of time. In simple terms, this rate is 1 divided by your payback formula. Number 2, measures of asset use. A good measure of asset use is given by the formula year-end receivables over average days sell. From host analysis, you may be able to recommend maintenance or improvement of your company's policies to improve your cash management operations. Other measures of this grouping are turnover rates. Turnover rates refer to the number of times a specific asset is used turned into cash in a normal business period. These ratios normally have to do with receivable and inventories. For your current assets turnover, the formula is cost of goods sold and operating expense less depreciation over current assets. The accounts receivables turnover is evaluated by the formula net sales for the period over average accounts and notes receivables. The number of days sales and receivables or the average time required to collect receivables is computed as follows. Average receivables over average daily sales accounts, where the average receivable is equal to total net receivables beginning plus ending divided by 2, and average daily sales is equal to the total annual sales divided by 360 or 365 depending on standard usage. Merchandise or inventory turnover ratios, on the other hand, evaluates your inventory position or the number of times your average inventory has been disposed and replenished during a given period. The formula for this ratio is cost of goods sold over average inventory for the period. Your number of days sales in inventories or the average time it requires to dispose of your inventory is computed by the following formula. Average inventory for the period over average daily cost of goods sold for the period. If your company comes up with several departmental product classifications, or you may want to compute each department's inventory turnovers. Furthermore, you may want to compute more specific inventory turnover ratios like finished goods turnover equals cost of goods sold over average finished goods inventory, goods in process turnover equals cost of goods manufactured over average goods in process inventory, raw materials turnover, cost of raw materials over average raw materials inventory. A gauge on how effectively you have utilized your plant and your equipment in terms of sales production will be detailed in your plant and equipment turnover ratio. This ratio is given by the format total sales for the period over total investment in plant and equipment. This last consideration may also be expanded to include other specific assets or owner's capital and compared with the total sales. Number 3. Measures of liquidity and use of debt. One of most valuable measurements of the company that should be known is its ability to meet its short-term indebtedness through the current ratio. This ratio is given by the formula current assets over current liabilities. The ratio, however, does not include a company's condition of immediate solvency, especially when inventories from a significant part of the company's total current assets. Instead, the acid test ratio or quick ratio is used. This ratio uses the company's cash, readily marketable securities, notes receivables, and account receivables, all known as the company's quick assets, which are divided by the total current liabilities. Other formulas that indicated measures of liquidity are A. Cash and cash accounts to average daily cash payments, and B. Payables outstanding to average days payables. Normally, your company's assets or some of it are offered as collaterals to some long-term debts. In such case, the ratio of your total debts or to total assets provides an excellent indication of your protection against your company's credits, as well as the possibility of securing additional indebtedness on the strength of some excess securities. Modification of this ratio are also available, all indicated of your company's specific assets as they compare with your total obligations. Some of these modifications are plant and equipment to long-term debt, owner's capital to total liabilities, total equity to total debt.
Next, the income statement. The income statement refers income and expense activity for a specific period of time. Number 1, sales. Number 2, less cost of goods, manufacturing and sold. Number 3, less operating expenses. 3.1, selling expenses. Letter A, salesman salaries and commissions and bonuses. B, traveling and transportation expenses. Letter C, advertising and publicity expenses. D, delivery expense. A, sales taxes. F, depreciation of delivery equipment and other store equipment used that are related to sales function. 3.2, administrative expenses. Letter A, salaries and expenses of general executives and the general accounting and credit departments. B, provision for the accounts. Letter C, contributions. D, professional fees. Letter A, certain tax. Letter F, depreciation of office buildings and office equipment. Letter G, amortization of intangible assets. 3.3, add other income. Letter A, interest income. B, dividend income. Letter C, rent income. D, royalties. 3.4, less other expenses. Letter A, interest expense charge. B, amortization of debt discounts. Letter C, losses on sale of marketable securities. Letter A, losses on sale of long-term investment or fixed assets. Letter F, losses on sale of obsolete machineries. Next, basic accounting equation. The basic accounting equation refers to balance sheet accounts. Assets equal liabilities plus owner's equity. Next, balance sheet. The two most important financial statements of enterprise are the income statement and balance sheet. The balance composed of three basic parts: assets, liabilities, and capital. Assets equal liabilities plus capital. A balance sheet includes assets, liabilities, net worth. The balance sheet is an accounting report of assets, liabilities, and capital of the company. Next, number 1, assets. 1.1, current assets. Letter A, cash, which may be on hand and or in bank. B, marketable securities, sometimes referred to as temporary investments, a readily marketable investment of company intended to convert or use as working capital when the need arises. Letter C, account receivables are often accounts not supported by promissory notes. Letter D, notes receivable are often accounts supported by formal written promises to pay. Letter A, inventories in manufacturing concerns are stocks of raw materials, stock in process or finished products which have been altered or converted into other forms before being made available for sale. Next, finished goods which are complete products ready for sale. Next, goods or work in process which are partially completed products requiring further processing before being made available for sale. Next, raw materials which are ready to process company's operational activities. Next, factory or manufacturing supplies which are like raw materials but those uses are not physically part of manufacturer process. Letter F, notes receivable are open accounts supported by formal written promises to pay. Next, 1.2, investments. 1.3, fixed assets. 1.4, intangible assets. 1.5, other assets. Letter A, organizational costs are expenses incurred in the forming, organizing, or establishment of business. Next, legal, close parenthesis, registration fees. Next, promotional or underwriting fees. Next, incorporation fees. Next, cost of printing of certificates of ownership, close parenthesis, tax and other printed requirements of company. Next, cost of service rendered that help in formulation of organization or establishment of business. Letter B, deferred charge costs that are neither inventories, prepared expenses, plant and equipment, nor intangible, which represent benefits for some future period and amortize over future periods benefited. Examples: plant management costs. Next, deferred pension costs. Next, research and development costs. Next, organization costs. Number 2, liabilities. 2.1, current liabilities. 3, accounts payable refers to indebtedness, representing large accounts or sole trade with sources or suppliers. B. Notes payable are obligations evidenced by formal written promises to pay. C. Dividend payable are the unpaid dividends declared with the company. D. Accrued expenses are obligations for expenses already made but not yet made. E. Income tax payables are liabilities for income tax payments computed from the current period. F. Customers' accounts with credit balances are obligations incurred as a result of advance payments by customers for company products either in the form of undelivered items, overpayments, returns, allowances, and errors. 2.2 Long-term liabilities. A. Advance payable are formal promises made under sale to pay specified amount of money at a specified future date. B. Premiums advance payable refers to unpaid balances of bonds purchased in excess of their face values. 2.3 Other long-term liabilities. 2.4 Deferred revenues. Next, long-term leasehold advances. Next, pays received in advance for long-term service. Next, deferred gross profit on installment sales. Number 3, stakeholders' equity and owner's capital. There is stockholders' equity. B, bid-in capital. C, capital stocks. D, treasury stocks. There A, retained earnings and appropriated retained earnings. Next, appropriate return earnings. Next, forecasting revenue and growth. Forecasting is calculating or predicting some future event or condition, usually as a result of study analysis of available pertinent data. Next, building financial forecast. The most common categories of expense are as follows. Number 1, fixed costs or overhead. Next, utility bills. Next, rent. Next, phone bills or communication costs. Next, account or bookkeeping. Then legal or insurance or licensing fees. Next, postage. Next, technology. Next, advertising and marketing. Next, salaries. Next, variable costs na siya under cost of goods sold. Next, materials and supply. Next, packaging. Next, direct labor costs. Number 1, customer service. Number 2, direct sales. Number 3, direct marketing. Next, roles and forecasting expenses. Number 1, double estimate for advertising and marketing costs, since they always escalate beyond expectation. Number 2, threefold estimates for legal, insurance, and licensing fees, since they are very hard to predict without experience and almost always exceed expectations. Number 3, keep track direct sales and customer service time as direct labor expense even when doing these activities during startup stage to forecast this expense with more clients. Next, forecast revenues. Conservative revenue projection might have following assumptions. Number 1, low price point. 2, marketing channels. 3, no sales staff. Number 4, 1 new product or service introduced each year for first 3 years. Next, aggressive case might have the following assumptions. Number 1, low price point for best product, higher price for premium product. Number 2, 3 to 4 marketing channels managed by marketing manager. Number 3, to salespeople feed on commission. Number 4, 1 new product or service introduced in the first year. 5 more products or services introduced for each segment of the market in 2 and 3. Next, key ratios and forecasting. Number 1, gross margin is the total direct cost to total revenue and during a given quarter or given year. Number 2, operating profit margin. Next, revenue forecasts are useful both for startups and existing business. Here is how to prepare. Number 1, decide on a timeline. Number 2, forecast your expenses. 2 types of expenses. Number 1, fixed cost. Number 2, variable cost. Next, forecast the sales. Number 1, identify customer base and determine which one include in the forecast. Number 2, plans for expansion. If so, include current geographical area as well as the area plan to include in the future. Number 3, marketing conditions. Number 4, business position. Number 5, seasonal adjustments. Next, source of information and forecasting. Number 1, look at the most recent consumer spending habits in the 2013 consumer expenditure reports from Bureau of Labor Statistics to see how in demand products or services are. Number 2, to find detailed information about the industry, visit the Bureau of the Industries at glance page. Number 3, check the most recent producer price index to determine price stability for the industry.
Steps to measure sales volume. First is determine how sales are calculated for the industry. Second is create a profile for ideal customer. Third is estimate the market share, determine the total number of available customers, and predict how many of them will be buying. Fourth is determine how often the customers will buy. Fifth is predict the average amount of each purchase for each product or service categories. To arrive at the project sales volume, use the given formula. number of customer times average sales price times number of yearly purchase equal yearly projected sales. Next is deduct total projected expenses and have revenue forecast. First, number of customers times average sales price times number of year purchase equal yearly projected sales. Second is yearly projected sales minus projected expense equal revenue forecast. So project cost forecast. When a project is executed, variance occur between the original cost and process planning and the actual course of the project. Simply shifting activities within flows is enough to change the pattern of cost in the project. Once the first actual costs have been incurred, it is necessary to check and possibly update the figures for the remaining costs. This is the only way to preserve a base for realistic forecasts during the whole of the life cycle of project. Cost forecasts are normally performed as a part of periodic process. If the company wants to run the cost forecast at a particular time and or in a background processing, one can plan it as a job in the schedule manager. Use the schedule manager monitor to check the scheduled job both during and after processing. Prerequisites. Prerequisites is the system determines cost to complete only for activity assigned networks which are both appended and apportioned. Process flow. Before accessing the cost forecast, the following are needed. Reschedule. No activity scheduling takes place in the cost forecast. It must be rescheduled first so that the clarification of the cost complete takes account of the change dates. Calculate overhead and actual end commitment values. The company must calculate the overhead and actual and commitment values separately for the calculation of the estimated cost at completion. The system determines the planned overhead for the cost to complete as a part of the cost forecast. First is choose financial period and closing single function to access the cost forecast. One can run the cost forecast is individual or collective processing. Second, based on plan, actual, and commitment values, the system determines the remaining cost in network activities. In doing this, the system includes all the actual and commitment values in the project, the plan values for network activities in the project, forecast values from confirmation. It does not include the following: WBS element plan values, network preliminary planning values, plan cost for material components in valued project stock. The cost simulation versions. Based on plan, actual, and commitment cost, the system determines what is to be done in network activities and costs this again. The system records the values so determined as cost to complete by period in a forecast version 4, and internally processed activities, externally processed activities, general cost activities, material components not managed as part of the project stock. The values are normally determined as of the first day of the current period as part of period end closing. However, one can have the option of specifying own key date for the cost forecast. The system uses the key date to determine the cost distribution. The result. The following forecast version values are available for evaluation in the project information system. First is cost to complete. Second, actual values at the time of the cost forecast. Third, commitment values at the time of the forecast. Cost control strategies. Time message has been gaining ground in the market with centers like Tonton Message offering stretching message known as WATPO. Without many amenities usually offered in a more expensive spas like sauna, shower, aromatherapy, big towels, and separate locker rooms. This enabled them to charge a low, competitive price while earning decent margins without the cost associated with electricity, water, oil, laundry, and rent of other spas. So product improvement. Product improvement involves changing some of the firm's product and market mixes. The two available strategies are product migration strategy and product integration strategy. Product migration strategy, also known as moving up the ladder strategy, has many names. It is called the planned obsolescence in the consumer durable market or cannibalization strategy in the non-durable goods like soaps and detergents. Vertical integration strategy. Vertical integration strategy can either be forward or backward. The objective is to gain economies of scale and to increase control and margin. For instance, Jollibee has their own bakery. Backward integration, providing them bread and other products. AgriNature, a leader in the fresh fruits and vegetable, has forward integrated by acquiring, among others, the Big Chill Stones as part of their integration among its farming, production, distribution, and retail division, shifting a former farm-to-market mindset to farm-to-plate method. Corporate retrenchment. The goal of corporate retrenchment is to remove excess fat and create a linear organization. Reorganization strategy. With fixed costs escalating and the number of qualified outlets with category authority decreasing, Water Philippines decided to get out of the distribution of their high-tech water purification products via retail stores. Profit. It is determined by the money get from sales, cost of stock if one sells products, and of course all the expenses incurred. It is reflected in reduction in liabilities, increase in assets, and or increase in owner's equity. Origin of profit. Profit or normal is a component of implicit cost and not component of business profit at all. It represents the opportunity cost and not component spends running the firm could be spent on running of different firm. Profit maximization. Profitability is a term of economic efficiency. Another significant factor for profit maximization is market fractionation. A company may sell goods in several regions or in several countries. Calculate net profit. Considering the following formulas: sales equal commission paid or discount given plus cost of goods plus gross profit. Gross profit equal variable plus fixed expenses plus net profit. Income earned by the business. Sales, gross profit, net profit. Sensitivity analysis. Gone are the days when owners or directors of major firms would agree to a long period before recovering their investments. Nowadays, the direction as well as the prejudice to the marketer is a bargain even at the least possible time because it is difficult to predict the future. Remember that profitability as a marketing objective is based on corporate objectives such that when the owner of firm targets 15% return on the sales, each marketing division of the firm using a sensitivity analysis, firms can determine the most efficient marketing mix combination to maximize profit in each segment. Margin return model, another available work on net sales and net profit. Strategies to maximize profits. Market entrenchment. The objective of market entrenchment is for firms to maintain and improve its existing market standing. If a firm is financially satisfactory, there is a strong likelihood of competitive pressure. Firms can minimize competitive vulnerability by either adopting market share protection strategy shorter term or repositioning strategy longer term. Market share protection strategy. For firms to attain superior profit, they must have a definite product market choice. In terms of product, firms can either go low cost by offering a basic but acceptable good product or go differentiated by offering more feature catering to those with superior needs. As low cost or lower cost producer, the firm can price its products lower than competition because of its economies of scale. Repositioning strategy. Arm & Hammer broadened their target market for their baking powder to include those wishing to deodorize the refrigerator. Campbell has a variant that is not just soap but a meal substitute as well, accidentally leaving a champion detergent in his car. TV host Ryan Agoncillo swears the scent is not overpowering unlike other detergent. In fact, it made his car smells clean. Market expansion. Market expansion is a costly strategy, similar to a repositioning strategy. Firms must have a financial resource to supply the increase in demand, either from additional capital or through borrowings. This is because as sales are increased, assets like inventories and delivery logistics must also be expanded. Multinational strategy. By redefining market boundaries from domestic to worldwide, firms like Jollibee embark on a multinational national strategy, targeting at least half of total revenues to come from outside the Philippines. Product full line strategy. Firms can also offer a complete line of products targeting a broader market base. For instance, SM has expanded from a shoe store to a department store to one-stop shopping complex offering practically everything that the middle class required. Consistent with their tagline, "We got it all for you." Volume improvement. A firm may have satisfactory profit margins but unsatisfactory returns due to heavy capitalization relative to sales volume, lack of availability, or risk associated with transaction. Sales stimulation strategy. By using an integrated promotion strategy of advertising, sales promotion, and selling, firms can improve. Coke is spending billions of pesos to stimulate demand for soft drinks, including the launch of Coke Zero, which target those who have stopped drinking soda due to sugar content. System selling strategy. To sell related and complementary products to the same customer is another alternative to increase sales volume. Cebuana Luwelier, the leading pawn shop in the country, has expanded beyond its traditional services and discovered the power of their distribution network in money transfer. Capital restructuring. In capital restructuring, the firm tries to remove some of their fixed, relatively non-controllable costs. Distribution product strategy is a firm can decrease their level of current assets by reducing inventory and receivables. Reseller alignment strategy. The firm can also decrease their fixed assets in the distribution channel. It can institute a telemarketing program instead of doing personal sales calls to marginal accounts like what Soy